Howdy, everybody. Welcome to Liberty Call. I am Raymond Dahlman, your humble host, and it is Thursday, June 22nd, 2023. Hope everybody's having a fantastical day out there in the interwebs. Got some clear skies for the moment here in Colorado. We've been having more and more rainy days, so I mean, everything is green. It is crazy. It feels like Houston with all the grass and the green stuff everywhere. But, can we have a break? I need to weed eat my yard, and didn't have a chance to do it this week since I was out of town over the weekend. But anyways, glad you're here. If it's your first time watching Liberty Call, thank you very much. Please give me some thumbs up, likes, shares, subscribes, follows, all that good stuff. I would greatly appreciate it. Another kind of a meh day in the markets. The Nasdaq and S&P 500 kind of bounced back from the last 3 days. But Dow Jones was flat, and see lots and lots of red across my screen from the last 24 hours. So let's go ahead and jump into the numbers and see how they turned out for today. All righty, the Dow Jones was flat, down 0.01%, closed at 33,946. S&P 500 was up 0.35%, closed at 4381. I'm sorry. The Dow Jones closed at 33,946. The Nasdaq was up 0.95%, closed at 13,630. The VIX fell 2.58%, down to 1286. Canada was down 0.63%. Brazil was down 1.19%. Mexico was down 0.92%. Over in Europe, Germany was down 0.22. UK was down 0.76. France down 0.79. Netherlands flat. Spain was down 0.76%, Italy down 0.72%, Switzerland up 0.09%, and Portugal down 0.92%. Russian exchanges both in the red, MOEX down 0.12%, and the RTSI down 0.15%. Overnights in Asia, the Nikkei in Japan was down 0.92%, Australia was down 1.63%, New Zealand down 0.94%, the Shanghai down 1.31%, the Shenzhen Component down 2.18%, China A50 down 1% even. Actually, all these are closed. So let me scratch what I just said. Looks like all the Chinese markets were not open in the last 24 hours. Even the Taiwan waited. So we'll stop there. So get ahead of myself. I didn't notice that they were already closed or that they didn't open today. All righty. So like I said, not the most excellent day in the markets, but is what it is. Like I've been saying, my expectation is that we'll probably have the downtrend will probably resume once the people on Wall Street and the big traders come to the realization that they are not going to get the Fed put that they had been hoping for and that they've gotten the last few times that the stock market had any sort of rockiness in front of it. There's no COVID money this time. So, and if there is, I think people will be up in arms if they try to do a bunch of spending like they did 3 summers ago. All right, well, let's go ahead and jump over to the market recap. Stocks are mixed as Powell appears in Senate. Tech stocks lift Nasdaq. All right, U.S. stocks had a mixed performance as Federal Reserve Chair Jerome Powell reiterated his stance on raising interest rates this year, while the Bank of England raised rates for the 13th consecutive time due to higher than expected inflation. I think we covered that yesterday, that the inflation in the UK is still quite elevated, around 8%, I believe. Powell, during his semi-annual testimony to Congress, stated that the Fed was not finished with rate hikes to address inflation. Despite the recent pause in rate increases, he emphasized that it would be appropriate to raise rates again this year, possibly twice, if the economy performs as expected. Powell's remarks indicated that further rate increases are likely if the economy follows its current trajectory, and futures traders have a 74% probability of a quarter-point rate hike at the Fed's July meeting. However, Powell emphasized that the Fed's decision will be guided by data. Recent inflation data has shown signs of a cooling economy, while the labor market remains stable, with initial job losses claims matching expectations. And again, let me pause here. The fact that the jobs numbers still look robust is primarily because those are lagging indicators. And it's something I've been covering with clients during our mid-year meetings right now, is that we start now with the good news. The good news is labor looks good, spending looks good, those sorts of things. It's the other things like the yield curve year over year, household net worth has been contracting. There's a bunch of other things. And so these things are what are telegraphing, folks like me to say, hey, things are not really that great. Even though the smart people on TV seem to think things are, we're behind the worst of it. I personally don't think so. All right. Jumping back in, the Nasdaq saw gains driven by tech stocks, particularly Amazon.com, which rose by 3.4%. On the other hand, Spirit AeroSystems Holdings, a supplier for Boeing, experienced an 8.6% drop in its stock price after announcing the suspension of production at its Kansas plant due to, an impending strike. The news has also affected Boeing shares, which fell by 2.4%. Darden Restaurants, the parent company of Olive Garden, witnessed a 3% decline in its stock price after providing annual revenue guidance that exceeded estimates. So exceeds estimates, and it could have also been exceeded estimates to the downside. Overall, the market response was mixed, with investors closely monitoring Powell's comments and the Bank of England's decision as they assess the potential impact on interest rates and inflation. So, is what it is. Again, I think things are actually going exceptionally well for, as bad as things, are particularly in the economy. So, most people in their day-to-day lives don't really see a lot of, the drama that goes on behind the scenes. But, it's a mess. All right. Next up, U.S. jobless claims hold at 20-month high. Existing home sales tick up in May. The number of first-time unemployment benefit claims in the U.S. remains steady at a 20-month high, indicating a potentially softening labor market amid the Federal Reserve's credit tightening measures. Data from the Bureau of Labor Statistics showed that 264,000 new claims were filed for jobless benefits in the week that ended June 17th, the same level as the previous week. Although new claims have risen by approximately 45% since September, they still align with a healthy job market. However, economists are uncertain about whether new claims or continuing claims, which have not shown a significant increase, provide a more accurate picture of the labor market's condition. The uncertainty surrounding the labor market's trajectory is crucial as the Federal Reserve approaches the end of its rate hike cycle, initiated back in March of last year to combat the inflation. While Fed Chair Jerome Powell suggested that 2 additional quarter-point rate hikes were likely by year-end, some policymakers are signaling a preference for keeping rates at the current level for a longer period. The housing market, which was impacted by previous rate hikes, is showing signs of stabilization, but the selling prices of existing homes experienced the largest year-over-year drop in over a decade. Limited house supply is also hindering improvement in the market. Although mortgage rates have declined somewhat this year, they remain relatively high, influencing the direction of home sales. The steady rates have resulted in consistent home sales in recent months, according to the National Association of Realtors. However, the low housing supply with a record low inventory of previously owned homes is contributing to a decline in median selling prices. Economists expect a recovery in prices due to strong demand and limited supply. Despite these challenges in the housing market and the uncertainty surrounding the labor market, the Federal Reserve continues to monitor data and adjust its tightening campaign accordingly. Okay, so housing is somewhat picking up, but there's still a lot lack of inventory out there, so it's still kind of a mess. I guess it just depends on where you want to live. If you want to move into the inner city, I'm sure there's plenty of space. If you want to move into downtown San Francisco, you probably pick up a really good deal. Same thing with like New York. Most of the blue cities that have high crime, you could probably move there really, really cheap. Kind of like inside the loop of Houston. Wouldn't want to live there. Well, maybe River Oaks and West U, but the rest of it, All right, last up on the docket comes from Zero Hedge. U.S. leading economic indicators tumble for the 14th straight month, signals weaker activity ahead. All right, the Conference Board's leading economic indicators in the U.S. experienced another decline in May, dropping by 0.7% compared with the previous month. While this decline was slightly better than the expected 0.8% drop, it marks the 14th consecutive monthly decline and the longest streak of decline since the period surrounding the Lehman Brothers collapse back in 2007 and 2008. The LEI provides insight into the future direction of the economy. Among the components of the LEI, building permits made the largest positive contribution at 0.15, indicating some strength in the housing market. On the other hand, average consumer expectations were the largest negative contributor at a negative 0.29, reflecting deteriorating sentiment about future business conditions. Justina Zabinski-Lamonica, senior manager at the Conference Board, noted that the decline in the LEI was driven by negative factors such as weakened consumer expectations, a negative yield spread, the ISM New Orders Index, and worsening credit conditions. Zabinski-Lamonica also mentioned that rising interest rates coupled with persistent inflation are likely to dampen economic activity further. This projection for a contraction in the U.S. economy from a third quarter from the third quarter of 2023 to the first quarter of 24, primarily due to continued monetary policy tightness and reduced government spending. The LEI's lack of signs of recovery, reaching its lowest point since December of 17, excluding the impact of COVID-19, raises concerns about the state of the economy. On a year-over-year basis, the LEI is down 7.9%, approaching the largest drop since the Lehman Brothers crisis of 08, excluding the effects of the COVID-19 lockdown induced collapse. These developments indicate a potential recession within the next 12 months, highlighting the impact of the Federal Reserve tightening measures on the U.S. economy. The LEI serves as a valuable indicator for assessing the overall economic outlook and could have implications for real GDP growth. All right. So what's the message of today's broadcast? That it's not real sunny on the horizon. And, that's what I've been telling clients in our meetings is that, a year from now, I feel pretty good. If we can keep the Fed and the government from touching everything and trying to put Band-Aids and, their fingers in the dam, trying to hold back the water, just leave it alone. Let it happen. Let's go through this market cycle without any sort of government influence or manipulation or price controls or anything like that. Let's just go through it, get through the other side like Andy Dufresne crawling through that pipe full of nasty stuff in Shawshank Redemption. Get out the other side and let's go, fix up that boat on the beach in Mexico. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information's there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.